How's it going, everyone? This is Israel, your loan officer down here in Southern California. Today is the first of the month, February 2021. We're going to be talking about inflation and GDP. I don't know about you guys, but this Saturday I went out with the family to this small place in Glendale, or shopping center, and it was just madness. It looked like it was Black Friday or the day after Thanksgiving. I mean, everything was packed. As you know, they lifted restrictions as far as restaurants and other small businesses down here in Southern California. And I was surprised. I was shocked. And in fact, this ties into today's article, which is economy set to bounce back strongly in 2021. It says Congressional Budget Office. Now, who is the Congressional Budget Office? Well, they were put together back in 1975, and the CBO, also known as CBO, has conducted independent analysis of economic issues to support the congressional budget process. Keyword here, independent. They don't care if Republicans or Democrats are in power. They just stick to the numbers. So the numbers that they put together are the following. Real GDP is expected to grow 3.7% in 2021. What I did is I went on Google and started pulling a bunch of data as far as the GDP, the year, and whatever was happening during that time. Why? So we can kind of get a sense of, well, if I remember back then things were like this, well, I can only imagine how things will be if they hit these numbers. And so that's the purpose of this timeline here. So as you know, 2001, it hit us with 9/11 and our GDP completely just collapsed, 1.0. And then back in 24, it was at 3.8. This was with the whole Spirit and Opportunity land on Mars. The skateboard, you guys remember the little skateboard? It was sent over to Mars, and that was happening back then. And we were at 3.8 GDP. Soon after that, we were at 2.9 back in 2006. And this is where the Fed said, okay, we gotta kind of keep an eye on the whole inflation. So let's put some brakes on this economy and let's start raising rates. And so that's what they did. 2008 financial crisis, we were at -1. And so right after that, what happened? 2009, still negative numbers. And then little by little, we started coming out of it. 2011, we were at 1.6. Then moving on to 2.2, 1.8, and then look at this, 3.1. This was when the whole TPP Iran deal was happening. And then soon after that, we kind of dipped down to a 1.7. And then again, we started climbing 2.3. And in 2008 is when the whole deficit spending was happening. We were at 3.0 GDP. Economy was doing good. Real estate, construction, everything was just chugging along. And then obviously, you know what happened before the COVID, we started with this whole trade war with China. They weren't paying taxes. We wanted to pay taxes for the products that they were bringing in. And so that kind of just hindered the progression that we were having. And we dipped down to 2.2, still pretty decent numbers. And as right now, it looks like we're averaging 1.47. So we're getting pretty close to that 2.2. All right, now, as you can see here, there's definitely a pattern that I've noticed, and I'll recap it again on a future graph that I had here for you guys. But 2006, it almost looks like every time the Feds are in the picture, they come in and start raising interest rates because they don't want inflation to get out of control. And so that really ties into the following two pieces of information that this CBO put together. It looks like the average GDP after the 5 years is going to be 2.6%. even without additional fiscal support from Washington. Now, that's really important because they're not taking into consideration these stimulus plans. And so if they were, this 2.6 could actually be looking at around 3.2, maybe 3.4. And the next thing that they also pointed out was that inflation will rise to 2.0 after 2023. So it's almost like the engine is starting, all the gears are moving, and right when we get to 2023, beginning of 2023, if they don't come in, which that's the next point, the Fed will start hiking rates in mid-2024 because they don't want this engine to go out of control and inflation to start rising. So I think by early 2024, maybe late 2023, that's when these really low mortgage rates are probably going to see their last days. Now, moving on to the next piece of info, this was the graph that I wanted to share with you guys, just so you can get a sense of where we are right now. Back in 2020, it was at 0.62. Right now, again, like I mentioned, I think we're averaging 1.42 GDP. So we are looking right around right here, back in 2019, maybe right here, 2016. And so as you can see, every time the GDP starts rising up, that's where the Feds come in and try to put a brake on that. All right, and the next one is going to be the mortgage-backed securities. Let's see how they reacted today. We're looking at 2%. Not a lot of activity, but still, positive numbers, they always help. And so let's see how those reflect on today's mortgage rates. We're going to start with a conventional loan. This is going to be 30-year fixed, and it only requires a 20% down payment on a purchase of a single family residence. 740s, anybody that has that FICO score or higher, it looks like they'll be getting a lower interest rate today versus the ones we were offering on Friday. And if you can look at the competition, 740s, if we were to do, compare apples to apples, their lowest one is averaging 2.75. That's with B of A. Again, we're offering a much competitive rate on that. Now let's move on to the second and probably the most widely used, FHA. Same deal, 30-year fix, except this only requires a 3.5% down payment. These are the rates from Friday versus the ones from today. And sadly, people with the 660s and 640 FICO ranges were affected a little bit. Their rates went up a little bit. But again, take a look at the competition. You can pause the video and see that they would require you to have a 740 FICO score to be able to offer you a 2.75, a 2.99, let alone a 2.990 with US banks. Here with us, looks like the lowest one is 660, and you can walk away with a 2.75 interest rate as of today. Again, all right, guys, and to finalize this video, I'd like to thank you for your time. Hopefully this information was helpful. Again, it kind of helps us to see where the economy is going to be heading and maybe make certain preparations, such as, well, maybe my FICO score is not high enough. Maybe I could, now that I have this timeline, I can start putting a game plan together and start fixing my credit. For all the homeowners out there, if you're thinking about, putting that house on the market, give us a call. We have a great team of professionals that will be able to help you as far as knowing what the equity is and how much your house can be sold for. You have to give us a call, 661-388-7667, and we'll be more than happy to give you any advice and information. Lastly, may God bless you. May God bless our nation, and I'll see you guys on the next video. Take care. Bye-bye.